Welcome back to the deep dive. Today, we're tackling the quarterly financials again. We're looking at a major digital financial player examining their Q2 FY26 results. And these results, well, they show some pretty explosive growth, right? But maybe more importantly, a real shift in how they actually make money.
Exactly. So for you listening, the mission today is really twofold. First, we need to get under the skin of this shift, moving from relying heavily on treasury income towards core business operations. That's a big deal for how you value the company.
Real inflection point.
Precisely.
Yeah.
And second, we've got to ask, is this incredible pace sustainable? I mean, launching funds left and right, scaling lending 12 times. Can they keep that up without things going sideways? We're basing this all on the unaudited results they released for the quarter ending September 30th, 2025.
Okay, let's dive right in then. Section 1, the consolidated picture, that financial muscle. So the top line numbers look, well, robust. Consolidated total income for Q2 FY26, it hit Rs 1,002 crores.
Yeah, that's a big number, a 44% increase year over year. But like you said, the volume isn't the whole story here. It's the quality of that revenue that's really shifted.
Right. And that's the net income from business operations. Grew nearly 5 times, 4.9x to be specific, year over year. That landed at Rs 317 crores. This is where that structural change really shows up, isn't it?
It absolutely is. What's fascinating, I think, is they've crossed this threshold. For the first time, the money they're making from their actual business lending fees, AMC fees, payment commissions, it's now more than their treasury income. Net income from business is, what, 52% of their consolidated net total income if you strip out a one-off dividend.
Wow. 52% now compared to just 14% in the same quarter last year. That's a massive jump. Why is that specific shift so critical for, say, an investor?
Well, it just changes the whole narrative, doesn't it, around sustainability, around valuation. See, when a company leans too heavily on treasury income, its fate is kind of tied to things it can't fully control, interest rate swings, market volatility. But by shifting earnings to core business fees, things become, well, more predictable, more repeatable, tied directly to how well they run the business, not just financial maneuvering. And that usually means Wall Street, or Dalal Street in this case, gives you a healthier valuation multiple in the long run.
Okay, so it validates that these new business lines, they're not just future promises anymore. They're actually generating solid income right now. And just to be clear for everyone listening, when we say net income from business, that includes the fees and interest from the NBFC, the payments bank,
Right.
plus fees from the asset management company, payment solutions, insurance broking, digital gold, the works.
Exactly. It shows the operational engine is really firing. And if you look at overall profitability, the pre-provisioning operating profit, PPOP, was RVIF 579 crores. That's up 5% year over year.
And PPOP, that's the key metric for operational profit before they account for potential loan losses, right? A pure measure of efficiency.
Precisely. It shows how well the core machine is running day to day.
And underpinning all this, a huge financial base. Consolidated net worth stands at Rs 1.35 lakh crores. That's not just a number, that's the firepower they talk about. It lets them absorb the risks that come with scaling so fast, particularly in lending.
Yeah, that capital base is critical. Which brings us nicely to Section 2, the engine room, the actual execution on the ground. Because those great financial numbers, they're a direct result of just how fast they're rolling out services. But, the question remains, are they moving too fast? What are the risks here?
That's the key tension, isn't it? Let's start with lending. The NBFC, GeoCredit Limited, the growth numbers here are just staggering.
They really are. Assets under management, the AUM, grew 12 times year over year. 12 times. Hit Rs 14,712 crores. And quarterly disbursements were huge too. Rs 6,624 crores.
Okay, 12x AUM growth in a year. That's phenomenal. But the obvious question is about quality, right? Are they sacrificing prudent lending for sheer volume? How's the risk management holding up?
And that's what you have to scrutinize. The results suggest they're trying to manage efficiency alongside that scale. Net interest income grew 142% YoY to Rs 140 crores. But maybe more telling is how they manage their funding costs. Their average cost of borrowing actually dropped quite a bit, down to 7.06% from 7.85% just the previous quarter.
Nearly 80 basis points lower. That's significant.
It's huge. It gives them a massive lever. They can either undercut competitors with cheaper loans or keep prices stable and enjoy a much healthier margin. To me, that signals strategic financial management, not just, reckless growth.
Okay, interesting. Let's shift to investing the Geo BlackRock AMC. This JV seems to be setting records for just launching products.
Incredibly fast.
Mhm.
Less than 4 months since they properly launched, and they've already got 9 funds out there. Index funds, cash funds, and their first active equity fund. Total AUM hit ours, 15,980 crores across those.
And the innovation there is worth noting too.
Definitely. That first active equity fund, the FlexiCap one, it used BlackRock's proprietary Tech Systematic Active Equity, or SAE. Now, SAE isn't your traditional fund manager picking stocks. It's about using complex quantitative models to generate investment signals systematically.
So more data-driven.
Exactly. And the market seemed to like this tech plus scale approach. The NFO raised nearly Rs 1,500 crores from over 480,000 investors. That's a pretty strong vote of confidence.
Huge validation. Okay, on to the transacting vertical payments and distribution. This is where the physical footprint expansion is just wild.
Yeah, the transaction processing volume for Geo Payment Solutions was up 167% YoY. Impressive. But the real story, I think, is the distribution network. Geo Payments Bank, their BC network business correspondence, it just exploded.
How much?
Well, get this. They went from about 2,300 BCs in Q2 last year to roughly 200,000 BCs in Q2 this year.
200,000.
Yeah.
Wow, that's the ground game right there. For listeners, these BCs are the local physical touch points. This means the company is embedding itself as the local financial service point for potentially millions, blending digital smarts with mass physical reach.
Precisely. That's how you get genuine mass market penetration, especially outside the big cities. And they're pairing that reach with some neat product ideas, too. JPBL launched Savings Pro, industry first apparently. It automatically sweeps idle cash into overnight mutual funds.
Maximizing yield without losing liquidity.
That's smart. Yeah. And they also grabbed mandates for digital toll processing at 12 plazas, including 2 of those new barrierless MLFF ones, multi-lane free float.
Right, the MLFF point shows they're integrating into core national infrastructure projects. That's significant. Okay, so connecting all this frantic execution, how many users are actually engaging with this stuff digitally?
The number they gave was around 18 million unique users across all their digital platforms, and that's in just 16 months since the main app launched.
18 million unique users already.
Which leads us perfectly into Section 3, because when you scale lending 12x, grow distribution almost 100x, and pull in 18 million users that fast, you inevitably create huge operational complexity.
Yeah.
And regulatory scrutiny.
Exactly. So how are they managing the risks that come with this, frankly, breakneck pace? What's the underlying strategy ensuring this is controlled growth, not just a dash for scale?
Well, they point to their strategic framework, which they call the 4Rs principles. And it's not just corporate speak. It seems to genuinely guide their decisions for sustainable growth.
Okay, let's quickly break down those 4 Rs for the listener.
Sure. First is reputation. Setting the highest ethical standards. Absolutely vital when trust is your main currency, especially online. Second, regulation. Operating strictly within the rules, aiming for best-in-class governance. Given how volatile fintech regulation can be, sticking close to RBI guidelines is key to avoiding major blowups.
Makes sense. And the last 2 Rs relate back to that big capital base we talked about.
Correct. Third is return of capital. This means deploying money prudently within defined risk limits. So, not chasing crazy yields with high-risk assets just for short-term gains. And fourth, return on capital. Ensuring a fair return for shareholders and stakeholders over time. It's the economic justification for all these massive investments.
And underpinning these principles, there's a big tech commitment, right? They talk about a zero-ops, AI-driven future. What does that actually mean in practice for a company like this?
Essentially radical automation. Think automated fraud checks, instant loan decisions for many customers without a human needing to look at it, automated compliance reporting. To make that work, they say their data infrastructure is solid. Data lakes are live across all parts of the business, feeding real-time analytics and machine learning models for better targeting and risk assessment. Critical for scaling credit safely.
Right, you need that data backbone. And finally, that huge capital position we mentioned, it got a boost this quarter.
It did. Shareholders approved the promoter investment of Rs 15,825 crores through preferential warrants, and the first chunk of that, Rs 3,956 crores, is already in the bank. This isn't just pocket money, it's a strategic buffer. It gives them enormous capacity to keep scaling those capital-hungry businesses, like lending and insurance, while still sticking to those 4Rs. It reinforces their ability to grow aggressively, but hopefully responsibly.
Okay, so wrapping up this deep dive, it really feels like this company is hitting a new stage of maturity. I think the two big takeaways for you, the listener, are one, that strategic shift is done. Core business income is now driving the train, proving the operational model works. And two, this incredible execution speed across lending, investing, distribution, it seems, sustained, for now at least, by massive capital and a strong governance framework.
Yeah, it demonstrates a really comprehensive strategy. They're trying to capture the whole financial life cycle, borrowing, investing, protecting, transacting all at once. And management specifically says they're building this intelligent and contextual targeting architecture using next-gen AI and analytics. The goal seems to be positioning their app as more than just a tool, but as this sort of trusted, smart advisor for millions.
Which brings us to our final thought for you to mull over. What happens long-term, societally, when a single entity combines this level of capital firepower, this kind of exponential physical reach? Remember those 200,000 distribution points and leverages truly intelligent personalization to target a rapidly growing base of, what was it, 18 million users. That combination, well, it suggests a potentially profound and very rapid reshaping of how financial services are accessed and consumed by pretty much everyone across the country in the next few years. Something to watch closely.